Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers. It's Sunday, November 30th, 2025, and we're here to break down all the market chatter from yesterday, November 29th.
That's right, Ethan. Our AI has been sifting through a pretty substantial number of posts and discussions, flagging quite a few different stocks. The sentiment out there is really a mixed bag this morning, you know? We've got some incredibly strong bullish vibes for a couple of big names, but also some significant red flags waving for others.
Absolutely, Brooke. There's a definite sense of both high potential and high risk floating around. It should be an interesting hunt today. All right, let's jump right into it. First up, we've got Intel, stock symbol INTC. We saw a sudden burst of activity around them after a couple of quiet days. There's a user out there who's just incredibly bullish, saying their INTC position basically saved them from financial despair. And you know, it's not just talk. Intel has seen an 82% return this year. Plus, there's news about their strategic direction and whispers of a potential chip partnership with Apple. That's growth potential right there.
Well, Ethan, while that personal story is compelling and the 82% return sounds fantastic, we have to look beyond the hype. The KPIs for Intel are frankly quite alarming. We're talking about an extremely high PE ratio of 676, yes, 676, coupled with a very low EPS of 0.06. That suggests the stock is significantly overvalued based on current earnings.
But Brooke, those news catalysts like the Apple partnership rumors could dramatically change their future earnings. Users are definitely looking forward, not just backward.
They could, and that's the hope. But then you look at their negative return on assets, meaning they're losing money relative to their assets, and a high debt-to-equity ratio. These are fundamental operational inefficiencies. While previous ratings have largely been stay away or speculative gamble, and this is no upgrade, the speculative nature of the current valuation is just too high for me. My AI-generated insights classify this as a stay away.
All right, a stay away for Intel it is, despite the pockets of optimism. Moving on to Alphabet, GOOG. This is where the optimism really shines. One user dug their Roth IRA out of the trenches, going from down 28,000 to up 51,000, attributing much of that to GOOG returns. The community is strongly bullish, even encouraging more aggressive trades. This stock has been a consistent buy for us recently.
And the data really backs up that sentiment for Alphabet. Their current price is very close to its 52-week high, signaling strong momentum. We're seeing healthy revenue growth at nearly 16%, an exceptionally high net profit margin of over 32%, and solid earnings per share. Even with a PE ratio of 31, which is higher than the market average, it's justifiable for a growth-oriented tech company like Alphabet. The news, especially around its potential in AI with Gemini and even Warren Buffett investing, provides strong fundamental support. This is definitely an upgrade from any previous stay-away ratings.
I agree, Brooke. The AI narrative, the fundamentals, and the strong community sentiment makes GOOG a compelling buy.
Absolutely, a clear buy for Alphabet.
Next up, Amazon, AMZN. Here, the sentiment is also overwhelmingly bullish, especially with the Cyber Monday sales talk. Users are expecting an endless aisle avalanche, predicting major gains. Plus, AWS is showing accelerating growth, and there's surging demand for AI services. Jim Cramer himself is endorsing Amazon, saying, "I think the doubters are wrong." We've seen AMZN swing between buy, cautious buy, and stay away recently, but this data looks positive.
The numbers for Amazon are indeed robust, Ethan. Revenue growth at 13.4% and a healthy net profit margin of over 11% show a company that's growing profitably. While its PE ratio of almost 33 suggests high market expectations, the ongoing strength in AWS and AI, as you mentioned, really underpins that valuation. The current price is also fairly close to its 52-week high, which indicates strong investor confidence. The AI-generated insights suggest a buy here.
I'm on board with that, Brooke. The e-commerce strength combined with the long-term drivers of AWS and AI makes AMZen a buy.
Agreed. A buy for Amazon.
Next up, MD, Advanced Micro Devices. The sentiment here is a bit different. While some news highlights positive developments like their Zaya 1 AI model, the overall tone in the community is pretty bearish. People are worried about Google's cheaper and more efficient TPUs disrupting the AI chip market. One user even took a short position, predicting AMD would drop significantly if NVIDIA did. This has consistently been a stay away for us.
You know, the bearish sentiment is heavily supported by the KPIs, Ethan. AMD has an extremely high PE ratio of almost 114, indicating a lot of future growth is already priced in. But then you have a very high debt-to-equity ratio and a relatively thin net profit margin. If competition from Google's TPUs leads to margin compression, as the community discusses, that thin margin is going to be squeezed hard. News of AMD stock suffers worst month since 2022 as Meta-Google chip talks shake AI market really validate those concerns. These are significant red flags that have led to previous stay-away ratings, and nothing here changes that.
So, even with some positive AI news, the competitive pressure and financial risks make MD a stay away.
Precisely. Stay away for MD.
All right, CME. This one generated a huge amount of discussion due to a pretty dramatic event. The posts reveal widespread anger and distrust after CME's data center overheated, causing futures trading to halt for hours. There's even accusations of market manipulation.
This is a deeply concerning situation, Ethan. A critical operational failure like that, combined with widespread allegations of incompetence and manipulation, severely erodes trust in a financial exchange. Their revenue growth is already negative at negative 0.03, and they have an extremely high debt-to-equity ratio. Rebuilding trust and fixing these issues will require significant investment, which could further strain their financials. Trading near its 52-week high with these fundamental issues makes it incredibly risky. This is definitely a stay-away classification.
There's no bullish spin I can put on a data center meltdown and manipulation accusations, Brooke. Stay away it is for CME.
Definitely.
Now NVIDIA, NVDA. This stock always sparks fierce debate. Our data showed the highest engagement today, over 200 hot leads. While some posts highlighted Google's TPUs as a threat, the majority of highly upvoted comments were bullish, or at least defensive. Users argue NVDA's software ecosystem like CUDA and their massive developer community give them an insurmountable moat. They also point to infinite market demand and question Google's ability to scale. Despite previous ratings being very mixed, even stay away yesterday, the community here is definitely leaning more positive. Ethan, I agree the bullish arguments about their ecosystem and market demand are compelling, and their current KPIs are, without a doubt, outstanding. Revenue growth at 62.5% and an operating margin of over 63% are just phenomenal. However, those very high numbers also make them a prime target for competition. Their PE ratio is 43.81, which means a lot of future growth and profitability is already baked into the price. The discussion about Google's TPUs and news that Meta is exploring cheaper alternatives represents a tangible threat to those margins and that growth rate. While the community is optimistic, the risks to maintaining those extraordinary KPIs are significant and could lead to a correction. Given the high valuation and the ongoing competitive debate, my AI-generated insights still classify this as a stay away.
That's a tough pill to swallow for some of our listeners, but the caution is warranted with that high PE and competitive landscape. Stay away for NVIDIA.
Lastly, Meta, MTA. We actually had two interesting perspectives on Meta today. First, we saw strong conviction from a user celebrating their DD post, claiming Meta is headed to $800 in Q1. Many agree it's a no-brainer investment, praising its resilience through dips. Their revenue growth is strong at over 26%, net profit margin is robust at nearly 31%, and the current price is well below its 52-week high, so there's plenty of room for upside. News also highlights their significant AI investments and strategic diversification, even reducing reliance on NVIDIA. We've seen this as a buy often in the past, and even a cautious buy yesterday.
But, Ethan, the second perspective for Meta, which emerged from discussions about Google's TPUs, introduced some serious caveats. Highly upvoted comments suggest Meta might be exploring these cheaper Google chips not because they're superior, but out of necessity due to a shortage of preferred NVIDIA GPUs. If Meta is forced to use substandard or less efficient AI hardware, it could actually hinder their long-term AI innovation and competitiveness, ultimately impacting future revenue growth and net profit margins despite any short-term cost savings. The uncertainty around their strategic AI hardware choices and whether they're making a pragmatic move or a forced compromise makes me wary.
That's a fair point, Brooke. The market is definitely looking for clarity on Meta's long-term AI strategy. While the core fundamentals and the general bullish sentiment are strong, that uncertainty around hardware choice does introduce a layer of risk. For that reason, I think a more prudent classification, reflecting both the strong underlying business but also the specific concerns you've raised, would be a cautious buy.
I can agree with cautious buy for Meta, acknowledging the strong fundamentals while being mindful of those strategic AI hardware challenges.
All right, let's wrap up our hunt for today. Here are the stocks our AI-generated insights have flagged for deeper analysis. Investigate as buy. Alphabet Inc., GOOG. Amazon.com, AMZN. Investigate as cautious buy. Meta Platforms, MTA. Investigate as speculative gamble. NVIDIA Corporation, NVDA.
And that brings us to the end of today's Daily Hunt for Multi-Baggers.
As always, remember, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in. We appreciate you joining us on The Daily Hunt. We'll catch you next time.